Most people think building wealth requires a huge salary, like you need to be making six figures, running a business, or getting lucky with crypto. And because of that belief, a lot of people never even start investing. They look at their paycheck, their bills, their rent, their groceries, and think, yeah, investing is for people with more money than me. But here's the strange thing. Some of the wealthiest long-term investors in the world didn't build wealth through massive one-time investments. They built it slowly, quietly, automatically, and often with amounts so small, most people wouldn't even take them seriously. So let's talk about a simple question. What actually happens if someone invests just $100 every month into an ETF? Not $1,000, not some unrealistic hustle harder amount, just $100. Because the answer is way more powerful than most people realize. Imagine two people. Both work normal jobs. Both earn average incomes. Both struggle with the same modern expenses. Rent, subscriptions, food delivery, rising prices, unexpected bills, neither of them feels rich. But one person decides to start investing $100 a month into a simple ETF tracking the stock market. The other says, I'll start later when I earn more. At first, their lives look almost identical. And this is where most people get confused about investing. Because in the beginning, investing feels painfully boring. You put in $100, and maybe your account grows by a few pounds. That's it. No dramatic transformation, no overnight success, no Lamborghini appearing outside your house, which is exactly why most people quit. Humans are naturally wired to chase visible results, and investing doesn't feel rewarding immediately. But this is where the math becomes interesting. Historically, broad stock market ETFs like the S&P 500 have averaged around 8% to 10% annual returns over long periods, not every year. Some years are terrible. Some years are amazing, but over decades, that average matters a lot. So let's use a realistic example. If someone invests $100 every month into a diversified ETF earning an average annual return of 8% for 40 years, what happens? Here's the math. Monthly investment, 100 annual return, 8% time invested, 40 years, using compound growth. After 10 years, you've invested $12,000 total, but your portfolio would be worth roughly $18,000, already more than what you contributed. Now here's where it gets crazy. After 20 years, you invested $24,000 portfolio value, around $59,000. Notice something important here. Your money is starting to grow faster than your contributions. That's compounding. Your investments begin generating returns, and then those returns begin generating their own returns. It's like planting seeds that grow trees that then grow more seeds. And this is why time matters more than intensity. Now let's jump to 30 years. Total invested, 36,000 estimated portfolio, around 139,000. And finally, after 40 years, you personally contributed $48,000, but your portfolio becomes approximately $324,000. Think about that for a second. You didn't invest hundreds of thousands. You invested less than the price of many people's monthly car payments, but time did the heavy lifting. This is the part most people underestimate. Wealth is usually built more by consistency than by intensity. Now, obviously, some people are thinking, okay, but 40 years is a long time. And yes, it is. But here's the uncomfortable truth. Those 40 years are going to pass anyway. The real question is, what happens during those years? Because most people already spend $100 monthly without noticing. A few takeaways. Subscriptions, impulse Amazon purchases, food delivery, convenience spending, random upgrades. Modern life is filled with invisible spending, and none of it feels dangerous in the moment. That's why it's powerful. Now, imagine redirecting just a small portion of that money toward ownership instead of consumption. That's what ETFs really are, ownership. When you buy an ETF tracking the stock market, you're not betting on one company. You're buying tiny pieces of hundreds of companies at once businesses, technology, healthcare, finance, global industries. So instead of trying to predict which single company will win, you simply invest in the overall growth of the economy itself. That simplicity is exactly why ETFs became so popular. Because historically, most professional investors struggle to consistently beat the market long term, which means the average person trying to constantly trade stocks often performs worse than someone quietly investing into a simple ETF every month. And there's another reason ETFs work so well. They remove emotion. Most people lose money investing for one reason: emotional decisions, fear when markets crash, greed when markets rise, panic selling, trying to time the market. But Automatic monthly investing changes the psychology completely. You stop trying to predict, you simply participate consistently. And consistency is incredibly powerful financially. Now, let's make this even more relatable. Imagine someone spends $5 a day on things they barely remember: coffee, snacks, impulse purchases, delivery fees. 5 feels tiny, but over a month, that's around 150 invested monthly instead at 8% annual growth. Over 40 years, that becomes roughly $486,000 from small daily decisions. That's almost £500,000 created from money most people psychologically classify as small. And this is where investing becomes less about finance and more about behavior, because the biggest obstacle isn't usually lack of information anymore. Most people already know investing matters. The real challenge is delaying gratification. Modern life constantly encourages spending now. One-click shopping. Buy now, pay later. Instant dopamine. Convenience culture. Everything pushes people toward immediate pleasure instead of long-term ownership. And honestly, that's why investing often feels emotionally difficult at first. Because when you invest money, nothing exciting happens immediately. Your lifestyle doesn't suddenly look richer. Nobody notices your ETF contributions online. Social media celebrates visible spending, not invisible investing. Nobody claps because you quietly bought index funds. But years later, the results become impossible to ignore. And this is where a huge mindset shift happens. Financial freedom usually doesn't come from dramatic decisions. It comes from repeated small behaviors. Tiny actions, repeated monthly, repeated yearly. That's what compounding actually is. Not just mathematical compounding, behavioral. Compounding smart habits repeated long enough eventually create massive outcomes. Now here's something even more important. The earlier you start, the less money you actually need to invest overall. Let's compare two people. Person A starts investing $100 monthly at age 25. Person B waits until age 35. Same investment, same ETF, same 8% return. By age 65, person A could have roughly $324,000. Person B, around $149,000. That's a difference of about $175,000. And the crazy part? Person A only invested for 10 extra years. This is why time is the real superpower in investing, not stock picking. Not perfect timing, not financial genius time. The problem is people massively underestimate what small amounts can become over long periods because humans naturally think short term. We struggle to emotionally connect with our future selves. That's why spending 100 today feels more real than the future value of investing it. But financially, your future self feels the difference massively. And honestly, that's what investing really is. It's sending money forward in time to support a future version of yourself. A version that may want less financial stress, more freedom, more choices, less dependence on paychecks, more peace of mind. That future doesn't appear automatically. It gets built slowly by decisions made today. And the beautiful thing about ETFs is that they make this process simple enough for ordinary people. You don't need to be a financial expert. You don't need to watch stock charts all day. You don't need perfect timing. You just need consistency. That's it. Small investments, repeated long enough. Inside assets that grow over time. That's how ordinary people quietly build extraordinary financial futures. Not quickly, not dramatically, but realistically. And honestly, that's what makes it powerful. Because the best investing strategy is usually the one you can actually stick to for decades, not the most exciting one, the most sustainable one. So if you take one thing from this video, let it be this. Never underestimate small amounts invested consistently over long periods of time. Because while most people are focused on looking rich today, quiet investors are slowly building freedom for tomorrow.